So that is what it exactly means. But to dive deeper into this, we are now joined by Mr. Anil Gupta, Senior Vice President and Go Group Head at ICRA. And we also have Mr. Sandeep Parekh, Managing Partner at FinSec Law Advisors. Gentlemen, thank you so much for taking your time out and joining us here today. Mr. Parekh, coming to you first. It's a complicated issue, not very easy to understand. Abhishek was just explaining how it will actually work and what kind of provisioning requirements and what kind of changes have been made. If you can tell us what is your take on the latest circular and any minute details or concords that you're missing out on.
So let me simplify this greatly. I think Abhishek went into some depth, but let me simplify it very, very quickly and kind of commonsensically. Essentially, what it's trying to do is two things. One is it doesn't want banks and NBFCs to do indirectly what they can't do directly, which is lend to specific sectors which they could not have done via investing in AIFs and then AIFs themselves investing. NBA, they don't want evergreening, which is kind of a shorthand for saying that, if your debtor comes into difficulty, you kind of, lend through an AIF by kind of investing into the AIF. And it doesn't become an NPA by this evergreen portion. So I think these are the two concerns which RBI had. So they have kind of disincentivized essentially investment into AIFs. Earlier they did it a little more abruptly, and then they, in 2024 they backtracked a little bit to rationalize it. And 25 is, I think, today what they've really done is they've introduced very simply put, they've introduced some caps on how much investments can be invested by banks and NBFCs into AIFs. They've said that, if these don't pass a particular smell test, then we'll ask you to create large provisions for these investments. And finally, I think, where they RBI is the least happy, they said that, we will deduct the capital ratio, the capital portion of the investments made from certain investments. So again, just to keep it very simple, not get too technical, the idea is not to allow banks and NBFCs to do indirectly what they cannot do directly.
Point completely. Mr. Gupta, coming to you then, if you have had conversations with the industry, with the AIF industry and also the BFSI sector, what has their response been, and are they seeking any change in limit in contrast to what has been proposed yesterday in the circular?
So I'll go back to maybe the initial circular which was issued in December 2023. At that point in time, we can say, the genesis of this circular was, as Sandeep highlighted, was the evergreening issue, which some of the entities were possibly using this route for evergreening of their exposures. So what RBI intent is, basically what is an NPA in regulated entity should also be an NPA irrespective of the color of the asset, whether it is an AIF investment or a loan book. So while this overall issue is not maybe very big in relation to the total AIF size of the industry, let's say AIF size for the industry is almost like 5.5 lakh crores. Or let's say when we look at the total investments by the regulated entities will not be more than 40,000 crores. So at an overall level, it may not be a very sizable problem. Maybe 3% of the total AIF investments are contributed by possibly the regulated entities. However, the challenge was that for some of the entities, it was a larger portion of their maybe a total asset book or maybe the net worth. So what was being done by few entities because of which this circular came was maybe the genesis is the wholesale exposures maybe during maybe the COVID era crisis when you restructured these loans by giving out moratorium. Even after moratorium, when these loans were not maybe paid off, you transferred it to an AIF structure where, because the NPA classification norms don't apply, you value them on a maybe a NAV which is declared by the AIF. So it does not then attract a provisioning requirement. Now this was something which got the attention of the regulator, and as Sandeep highlighted, that possibly it was maybe one time strong reaction which said that okay, you provision entire 100% of your investments in the AIF. Now, the new regulations which have been notified yesterday, basically these are more practical, which says that, okay, you make a provision only to the extent of your share of investments in the AIF. If you are holding only 10% of the AIF corpus, then make a provision only to the extent of 10% of the exposure which AIF has. So that's the broad. Maybe I'll give you with some number. Let's say if an AIF of 100 crores has invested into a company, let's say 20 crores has been invested, right? Which is 20%, right? And the regulated entity has 10% share in or 10 crores in the AIF. Then you go and make a provision of 2 crores on your 10 crore investment, not entire 10 crore provisioning. So that is what the intent, and I think it is more practical approach rather than maybe a kind of what we can say in the hindsight, a knee-jerk approach to make 100% provision.
Hi sir, this is Abhishek here. So first of all, if you can explain that there are certain exemptions have been given to certain kind of AIF. So what are they, if you can explain them?
Sure. So you can say there are certain sovereign funds which are also in the nature of AIFs, right? So we have NIF, right, which is a fund, AIF, right? So if the investments are going into certain category of funds which are strategically important for the government, for the infrastructure development, possibly those are the investments which possibly will not be maybe requiring such provisions or will be out of the purview of the circular which has been notified.
Do you think that this kind of tightening of regulations will have some kind of impact on the fundraising activity of this AIF?
So as I mentioned, maybe at an overall industry level, maybe the regulated entities will not be contributing more than maybe 3%, 4% at max into these AIF corpus. So that is our maybe broad estimate, because even when this provisioning requirement kicked in December 2023, and the provisions were taken across by banks, NBFCs, the provisions didn't went up significantly, maybe across the industry. Maybe it was high for few individual entities because their exposures was high. But at an overall industry level, it is not a very material contributor to the corpus of AIF. So unlikely it will have a negative impact, but definitely should have a positive impact given the clarity on the maybe the thresholds which the industry can now put. In fact, it says that if it is the corpus contribution is less than 5%, then these provisioning requirement does not kick in. And only beyond when you are more than 5% into the AIF corpus, these provisioning requirement kick in.
Here just I would like to speak with Mr. Sandeep sir. Sir, you have initially said that this kind of regulations are basically disincentivize the investment in the AIF and all these things. So basically, how do you see the overall AIF industry in perspective of the regulation? AIF industry is expected to reach by around 100 lakh crore by 2030. So do you think that this kind of regulations will emerge as a barrier for the in front of AIF to grow from here, or do you think that because of this kind of regulations, the transparency will come in the overall industry and they will enter into the next trajectory of the growth, as we have seen in the case of mutual funds around 10-15 years back?
So I think just to put the principle first, all laws impose a cost on the honest people as well, right? So certainly it will impact the people who try to circumvent the law, but it will also hurt people who had genuine investments in AIS. So there will be some impact. But like my previous speaker said, I think statistically it's not a significant number in terms of banks and NBFCs investing in AIS. So it's not likely to have a big adverse impact. In specific cases, yes, it could impact fundraising to some extent, but overall may not be very significant, and certainly it will curb the misuse which is happening, which is in fact, from what I hear, SEBI itself had reported to SEBI that there is some misuse happening. So I think it's an interregulatory decision they've taken, and it's certainly in good spirit. It was too too restrictive in 2023, but I think 24 they kind of liberalized it to exclude, for instance, equity investments, because that was not the purpose of the evergreening restriction. I think they have kind of rationalized it. Whether it will impact overall flows, my guess is not, but certainly it will impact some honest flows for sure.
One last question before we let you go. Is there any ambiguity in any of the points of the circular the government has come out with, or is it fine and the BFSI and the NBFC sector will be able to abide that as soon as it comes into implementation?
So I'm guessing it's for me.
Yes.
No, so I think when this thing first came out in December 2023, it was kind of bit of a knee-jerk circular, and therefore I think a lot of people who had already made investments had issues with it. I think now it's kind of people know how to play by the rules, and should not have a substantial market impact.
At that point completely. Mr. Parekh and Mr. Gupta, thank you so much for taking your time out and joining us here on ET Now and helping us understand what that circular actually means and what kind of impact will that have on the banking and financial services sector. Thanks so much for joining us. That's all the time we have on this edition of the show, but don't go anywhere. Closing trades coming up next.